You owe taxes. That's right, you owe taxes. Well, Roger, isn't there something there can do about it? Of course there is, and that's what today is all about. Hey gang, I'm Roger Herring. I am the investor's accountant. Welcome to another edition of Ask Roger. Everybody wants to know this time of year, what can I do to reduce tax? Well, you should have been thinking about this all year, but since you're asking now, let's talk about the things. The first and the most important thing you got to know, how much money did you make? It blows my mind how many small business owners don't have a clue how much their profit is. They know how much their gross income is, but they have no idea how much they're netting, meaning how much money they have kept. A lot of people's accounting system, unfortunately, is, well, I had this much, I got this much now, so I must have spent this much. Now, you got to know what is your net income before your compensation. We got to know that because that's the starting point, because if you're in an S Corp and if you have ordinary income, you should be in an S Corp. All right? You got to pay a salary. The law requires a normal and reasonable salary. Well, how much is normal and reasonable? Probably around 40%, and as you are making more money, that number actually goes down. We've got a chart that we use, compliments of Mr. Mark Kohler, my mentor. We use that chart to show exactly how much our clients should be paying themselves in salary. Second thing, I want to have a 401k, specifically a solo 401k, where the only participants are you, and if you're married, your spouse. You don't have any other employees. Now, here's the deal. If you have employees, you can't use a solo K. You can use a regular 401k or a safe harbor 401k, but you can't have a solo. So let me tell you about a solo. If you are under 50 years old, you can put away as an employee contribution. All right, you ready? $22,500. If you're my age, I'm over 50. I can put away $30,000. Now, here's the deal. I have to make those payments by 12/31. That's the employee's portion, the $22,500 or the $30,000. The employer match I can make later. How much is the employer match? 25% of my salary is the employer match. Now, here's the deal. The employee side can be deductible or it can be Roth. Deductible means it goes into a traditional 401k and you pay tax on the back end. Call it pay as you exit. All right? Roth, you're never going to pay tax. But you're not going to reduce your income right now either. So you have to make a very big decision. Do I take this as Roth or do I take this as traditional? Now, even though a law was passed that allows the employer match to go to Roth, guess what? There's no system out there set up to make that employer match be Roth. Right now it's going to go into a traditional component, but you could always convert it to Roth. No big deal, especially if it's done in the current year. We just added the compensation. Okay? No big deal there. Next thing you should do is you should have a Roth IRA. Well, Roger, I make too much money for a Roth IRA. A Roth IRA. No, you don't. Nobody makes too much money to have a Roth IRA if you know the rules. You can do a backdoor Roth. Well, Roger, what the heck is that? You set up a traditional IRA, make a contribution, and immediately convert it to Roth. You see, the income limits are based on contribution. There are no income limits currently for conversion. Now, if you've got other traditional IRAs out there, you can't do the back door. The back door is locked. That's going to make some of that conversion taxable. But if you've got a solo K, a traditional IRA, and a Roth IRA, just roll that traditional IRA over into the 401k, and now you have unlocked the door. All right? Remember, this has to be done by when? January 31st, so if you don't have a solo K, you better get moving. Who do you recommend, Raj? There's a lot of people out there. I personally am with American IRA out of Asheville, North Carolina. You can find them at AmericanIRA.com. All right. Now, if you add your spouse to the payroll, you can double the 401k contribution and essentially add either $22,500 or $30,000 to your write-off or to your Roth, whichever you want. Okay, here's how it works. I can split the salary between spouses. So instead of a $90,000 salary, each spouse gets what? $45,000. Each spouse, if they are under 50, can do $22,500. Or if they're over 50, they can do up to $30,000. The match is what? 25% of the salary. The salary is still $90,000. So the match is just going to be split between husband and wife in this case. So making the spouse an employee for purposes of 401k is an excellent idea. And once again, you can decide, take the deduction or make it a Roth. Now, one of my favorite strategies is to pay the kiddies. You can check out my other videos on this, but you got to do it by 12/31. How much can I pay them, Roger? Up to $13,450 this year. That'll probably go up to 14 even or so next year. Here's the main thing. There are rules and there are ways to do it, especially if you want to avoid this nasty thing called Social Security Medicare. So why pay that if you don't have to? Check out my video on how to pay your kids. I explain everything. Now, if you are a real estate professional and you have bought rental property, then it's time to consider, do I want to do a cost segregation to offset my income? What is a cost segregation? Once again, I've got a video on it, but in a nutshell, cost segregation accelerates depreciation. It allows us to take the components of the house and separate them from the house. You can also do it with a commercial building. A house is depreciated over 27 and a half years. A commercial building over 39. Would it be nice to be able to depreciate them over 5, 7, and 15 instead? Well, how about bonus depreciation? If the house was bought this year, 2023, you have 80% bonus depreciation. If the house was bought between 2018 and 2022, that's right, 2018 to 2022, guess what? You got 100% bonus depreciation. So let's say that I have a $100,000 basis. I use 20% as a planning figure. All right, that's a $20,000 write-off. Could be more, could be less. It all depends on the property. 20% is the planning figure. Now, here's the key. You better be a real estate pro in order to go below zero. Check out my video on Real Estate Pro. Or if you've got rental income that needs to be offset, cost segregation is a great way to bring your income down to zero, so you're putting all that positive cash flow in your pocket and you're not paying any tax. All right, guys, those are some key things that you as a small business owner can do between now and the end of the year to reduce those taxes, or even better, get money into tax-free environments using Roths that will grow forever tax-free. Now, one last thing that I want to leave you with for hanging with me today, I've got a gift for you. You want some of my tax strategies? All you got to do is click the link down below and fill out a simple 3-line form, and you will immediately be able to download a PDF of some of my favorite tax strategies for small business. Check it out. Till the next time, Roger out.